Exchange-traded funds, or ETFs, are investment funds traded on stock exchanges. They combine the features of both mutual funds and individual stocks, offering a unique investment vehicle. They are similar to mutual funds, but trade like individual stocks, allowing investors to buy and sell them throughout the trading day at market prices. ETFs offer diversification, flexibility, and cost-effectiveness, making them popular among investors. They provide exposure to a wide range of asset classes and sectors. ETFs can hold various assets, including stocks, bonds, or commodities, and they provide a convenient way to access different market segments. This allows investors to tailor their portfolios to their specific investment goals. ETFs are gaining popularity due to several factors, including their ease of use and the broad market exposure they offer. First, they offer diversification by investing in a basket of assets, reducing risk compared to individual stock picking. This helps in spreading out the investment risk. Second, ETFs are highly liquid, meaning you can buy and sell them quickly on stock exchanges throughout the trading day. This liquidity provides investors with the flexibility to react to market changes. Third, ETFs typically have lower expense ratios compared to actively managed mutual funds, making them a cost-effective investment option. This lower cost can lead to higher net returns over time. Active ETFs are managed by portfolio managers who actively select and trade securities to outperform a specific benchmark or index. These managers conduct in-depth research, analyze market trends, and use their expertise to make investment decisions. They aim to generate higher returns than the benchmark by identifying undervalued stocks, timing market movements, or implementing other investment strategies. However, active management comes with higher costs. Active ETFs typically have higher expense ratios than passive ETFs due to the costs associated with research, trading, and portfolio management. The success of an active ETF heavily relies on the portfolio manager's skill and ability to outperform the market consistently. Passive ETFs, also known as index ETFs, are designed to track the performance of a specific market index, such as the S&P 500 or the MSCI World Index. Instead of trying to beat the market, passive ETFs aim to replicate the returns of the underlying index. They do this by holding the same securities in the same proportions as the index they track. Passive ETFs are known for their low costs, as they require minimal trading and management. They provide investors with broad market exposure and are suitable for investors seeking long-term growth without the need for active stock selection or market timing. Section 4. Pros and cons, active versus passive. Active ETFs offer the potential for higher returns by attempting to outperform the market. These funds are managed by professionals who actively make decisions about which stocks to buy and sell. Skilled portfolio managers can identify investment opportunities and capitalize on market inefficiencies. They use their expertise and research to make informed decisions, aiming to generate alpha. However, active management also carries the risk of underperforming the market, and the higher expense ratios can eat into returns. The costs associated with active management can sometimes outweigh the benefits. Passive ETFs, on the other hand, provide diversification, low costs, and transparency. These funds track a specific index and aim to replicate its performance. They eliminate the risk of human error in stock selection and are suitable for investors who believe in the efficiency of the market. Passive investing is often seen as a safer, more predictable approach. However, passive ETFs will only match the market's performance, and investors seeking to significantly outperform the market may not find passive ETFs suitable. For those looking for higher returns, active management might be more appealing despite its risks. Section 5. Choosing the right strategy for you. The choice between active and passive ETFs depends on your individual financial goals, risk tolerance, and investment horizon. It's essential to understand the differences between these two strategies to make an informed decision. If you are a long-term investor who believes in the efficiency of the market and prefers a low-cost, diversified approach, passive ETFs might be the right choice. These funds aim to replicate the performance of a specific index, offering broad market exposure. If you are comfortable with higher risks, believe in the potential of active management to generate alpha, and have a longer investment horizon, active ETFs might be worth considering. Active ETFs are managed by professionals who aim to outperform the market through strategic stock selection. However, remember that past performance is not indicative of future results, and choosing an active ETF requires careful research and due diligence. It's crucial to evaluate the fund manager's track record and investment strategy. Carefully consider your investment goals, risk tolerance, and time horizon to determine the most suitable approach. Consulting with a financial advisor can also provide valuable insights tailored to your specific situation.